So I wrote a paper recently about why it is so hard to be an active investor. And what I want to talk to you today is about that. We've all seen the herd mentality move many people to passive indexes. I would remind you that things like the S&P 500 are strategies, right? The strategy there is buy big stocks. Single line strategy. Globally, it's buy these global big stocks based on their market capitalization. Through the research that I and my team have conducted, we have found that there are very many other factors that work significantly better than buy big stocks. The challenge that we face there, however, is by definition, our portfolios are very different than the benchmark if the benchmark is the S&P 500. And the first thing that we really want to think about is passive investors, they face one point of failure, right? Presuming they're well diversified, etc., the only point of failure that an active investor faces is panicking near a market bottom and selling out of all of his or her index funds, okay? That's really the only thing they have to worry about. Because by definition, they're getting the average return, they're getting low costs, they're getting a lot of really good things. But they do face that point of failure, and sadly, I have seen many people who swore that they would never ever do such a thing, do exactly that. But us poor hapless active investors face 2 points of failure. The first is the same as the index investor, right? We panic and we sell out before or near the bottom of a market. But the second one is really more insidious. The second point of failure that we face is we suddenly are comparing our returns of our investment strategy or our ETF or our mutual fund with its benchmark, right? Everything has a benchmark, and if you're a value investor and it's a large cap strategy, your benchmark is the Russell 1000 Value Index. If you're a small cap value, it's the small cap Russell Value Index. And we compare these things constantly. And what I have witnessed over my entire career is that really human behavior never changes. We're going to get back to that in a minute. But typically what happens is that people mismatch their time frames, right? So the majority of people who are actually making decisions on whether they're going to stick to an active strategy are using possibly the worst time frame to look at, and that is 3 years. I won't bore you with a lot of people that I know who do it on a quarterly basis. But what I can tell you is that if you do this on a quarterly basis, I will guarantee that you will fail. Because quarterly data, there is no signal, it is all noise. And because of the nature of human beings, we always will clamp a narrative around anything that we see. And the narrative is going to sound really interesting. You're going to watch CNBC and you're going to hear some guy say, well, this quarter happened because of X, Y, and Z. Well, let me be the one to tell you, having been on CNBC a lot, he is absolutely full of it. He thought about that on the way over there, honestly, because he has no idea why the quarter did what it did. No one does. And so when we accept that fact and start trying to look at longer periods of time, we're much better off. But 3 years, absolutely one of the worst things that you can look at. As a matter of fact, a friend of mine, Josh Brown, who blogs at a site called The Reform Broker, found a really neat study. And this study basically showed that investors who fired an active manager for underperformance and hired somebody else, guess what happens? The manager they fired goes on to do vastly better than the manager they hired. I'm sure many of you are engineers, so you understand the concept of reversion to the mean. They had a bad 3-year period, generally, not always, but generally followed by a good 3-year period. The manager that was hired, well, guess what? They're coming off a great 3-year period, and we love those numbers. We just love seeing them beat that benchmark, and yet we really don't know why they might have done it. Two stories that I think are interesting that will help us understand why sort of the long term is against us. The first is human nature. We are very temporal creatures. And there's a bias in behavioral finance called the recency bias. And we are all subject to it. Everyone in this room, everyone on this campus, everyone in this state, in this country. Recency bias simply says we pay the greatest attention to what has happened recently. And then to compound our error, we forecast whatever has been happening recently into the future. A very, very bad mistake to make.